Hello and welcome back to the Note, back again after a month's break. Now, the very risk-averse tone on world markets that we've seen for the last few days continue today, and I suspect it will intensify over the hours that come because of a big announcement we've had after the markets closed here in New York. It came from MSCI, the main indexer of emerging market equities, and they have decided not to include Chinese A-shares in their main MSCI emerging markets index for another year. Now, that is hugely important because of the importance these days of both passive funds and of benchmarked active funds. Any decision to do so would have brought a lot of money flowing towards China. Now, if we take a look at this first chart, you can see that China is already, not surprisingly, very much the largest component of the MSCI emerging markets, but that's all either ADRs or Hong Kong quoted H shares. Domestic A shares are not included at all because of various problems to do with their openness to the international market. Now, the argument in favour of including A shares is very simple. The A shares market is now the second largest stock market in the world, bigger even than Japan, second only to the US. It's really very hard in many ways to justify a benchmark of emerging markets that doesn't include such an enormous chunk of it. Also, China has been arguing plainly badly, wants to be included in the MSCI index. It's been arguing that it has done a lot to open itself to international investing, which is true. However, MSCI, I thought in its statement, made a very clear argument that China still has to do far more. It found that many of the investing institutions, which are very important to MSCI and have been arguing strongly against A-shares inclusion, are still complaining that it is too difficult to repatriate their money if they need to do so. There have been changes made by China, but they are still not enough. There are also complaints about the phenomenon in China of the possibility of voluntary suspensions of stocks when things are getting hectic in the markets. MSCI pointed out very directly that that is unique not only to the emerging markets but to any stock market MSCI covers anywhere around the world. Now, you can see the importance of this if we take a look at this next chart, which shows you what has happened to Chinese A-shares and to the MSCI emerging markets in general since the last MSCI annual review a year ago, which very surprisingly at the time decided not to include A-shares in the index at all. As you can see, that maybe coincidentally, but probably not, triggered a very big sell-off in Chinese A-shares and in Chinese markets more broadly and in emerging markets more broadly. There had been a lot of hope, including among people who had been in favour of delaying last year, that this would be the time to include A-shares. I think that means that we will see some further turbulence and probably some further falls both in China and elsewhere over the coming hours. But ultimately, even if MSCI takes some heat over this, I think it has made the correct decision. Ultimately, I think the message for China, which MSCI's institutional clients wanted to get across, is an important one. If China wants the capitalist West's money to flow in, it has to be prepared to let it flow out again.